All right, Anastasia, Buy America, question mark.
Yes, the answer to that is yes. And, Alex, the reason to that, if you look at the U.S. economy versus the European, for example, we are in such much better shape. I think part of that has to do with the U.S. lack of interest rate sensitivity. And what I mean by that, if you look at mortgage balances, for example, in the United States, they're not adjustable rate mortgages. They're fixed rate mortgages. And we know that's not the case in Europe, where a large percentage of those mortgages are adjusting higher. And that is a pain point for the consumer there. That is not the case in the U.S. Then I think about the energy story. And, first of all, U.S. is a net exporter of energy. Europe, for example, is a net importer. And when you think about the beneficiaries of high oil prices, of course, it's energy stocks. And in the U.S., they're benefiting. So there's many reasons to kind of think that it is a buy U.S. story. U.S. is on pace to grow 1.5% or 2% consensus GDP growth this year. Europe maybe is just going to deliver right around zero. So I think it is a buy America story. It is a buy tech story. And of course, there's a lot of tech in the U.S.
Anastasia, America's expensive, tech is expensive, Europe is cheap. Isn't that enough to maybe look outside the United States?
No, it's not enough. And yes, you're right, Guy, that the discount of Europe relative to the U.S. is at one of the highest levels we've seen. But, I always look at a formula, which is valuations plus positioning plus a catalyst. And, yes, you may have a valuation that is cheap, but what is going to be that catalyst that is going to propel Europe high near term, for example? And by the way, this may all change, and we can have a very different conversation a couple of months from now. But for now, what I know is the earnings revision story, for example, in the U.S., is the catalyst for U.S. stocks. And if I look at earnings revisions for U.S. stocks looking out at this year, their net positive earnings revisions are now 23% versus plus 3% for the world and something in between for Europe. Mm-hmm. So, I think it's lacking that catalyst for Europe at the very moment.
The argument that if there is a disruption, the U.S. has more to fall than Europe. I understand that's a different take on the value play, but if we do get into a harder landing where the consumer falls out of bed, U.S. is going to crater a lot more.
Well, I don't know if that's a given, because when I think about the imbalances that we have today, for the U.S. to crater a lot more, we have to have this excessive leverage, and when I look at the consumer has delevered. When I look at corporate balance sheets, whether it's investment grade, whether it's a high yield, we're actually in better shape than we were during the financial crisis or immediately after that. So the big question mark for the U.S., of course, is what's going to happen with government debt, and there's concerns around that are being priced into the market. But corporate American consumer, I don't think would crater because there's not this deleveraging spiral that would be offset.
In terms of why this is happening, is it because simply the federal government is continuing to spend money at an aggressive rate, which makes the American economy look so much better, and by extension, therefore people want to own US stocks? And as you say, isn't the risk therefore around the US bond market, we talk about buy America. Are we being very specific here? Is it buy American stocks, not American bonds?
Yeah, I think you're right, Guy. It is buy American stocks. I am concerned about parts of the bond market. There's some good news for why bond yields are rising, but there could potentially be some bad news. The good news is bond yields are rising because growth is rising. Growth expectations are rising, and of course that's a benefit for stocks. But we could also get a worse move in Treasury yields, for example, if there is more of a concern about budget deficit spending that we have not addressed, and the fact that we're going to continue this for several years, that will add to additional interest rate expenses. So I'm concerned that bond yields may move higher because of that additional issuance that is coming. So it is buy stocks and not bonds. And, to your question about why is this happening, why is there this U.S. resilience, I think it is, again, lack of interest rate exposure. But if you look at unemployment rate, 3.8%, if you look at wage growth, it is still very much on pace, for 4% year-over-year gains for the U.S. consumer. So all of those things contribute. And by the way, just last Friday, we got the consumer household net worth number, which is $154 trillion. So we've had a large, substantial gain in consumer household net worth. Yep. So consumers feel well off, and I think that's why they continue to spend as well.
Despite the fact we just had that headline that household wealth, right, for 2022 was up fell 2.3%. But it's like a bifurcated.
The median income versus household net worth, but you still square that with people have jobs and they're getting paid more for those jobs, and I think that's what's propping up the sentiment.
Is it a sell EM or a sell China thing?
Well, You know, when I think of China, I don't think you want to sell at this very moment because it is probably the world's least favorite trade at the moment. So going back to this sort of, positioning and valuation and catalyst standpoint, I do think that China is very unloved and therefore contrarian. And the government there is certainly trying to do more and more to stimulate the economy. I suspect at some point over the coming months they will be successful. And so the data that we're going to see coming out of China is not going to be as dire as it is right now. So I don't think it's sell China, but when I look at emerging markets, emerging market revisions have been very negative relative to the US. So I'm probably not going to be quick to step into that.